Well, Doug, I'm going to get us started. I know there's a couple more going to be coming in, and as they come in, I'll just click them in. We do have the recording piece started. Welcome, everyone. I'm greatly appreciative that you're here today, and I'm very pleased to introduce CPA Doug Dickey out of Houston, Texas. Doug and I have been working together for several years now with a lot of clients all over the country, but a lot here in California who are looking for tax relief in some form or fashion. Doug and I were working on multiple projects, and then he introduced me to the way that he was using a management services organization, which was quite interesting. And I'm like, wow, that's really cool for the right client. And so we're going to introduce you today to a concept using a management service organization, which can be done with a C Corp and some other variations as well. It's a tax mitigation strategy that is basically for that entrepreneur type person. And this strategy is not for everybody. But for that entrepreneur who's growing wealth, building business wealth, who is living on less than what they're making, who's trying to expand and grow, who's trying to create a succession plan, who's doing the things that we'd love to see entrepreneurs do, how can we help them control their wealth and control their tax in a very safe way? And we're also very smart about always making certain the client has the highest degree of asset protection that we can get for them, in addition to any type of umbrella policies and things of that nature. Doug, if you would, go ahead and bring the slide tray up. And Doug Dickey is a CPA with a team of about 50 people in Houston with offices in multiple states as well. And Doug and I have made presentations on this topic countless times across the country. In fact, we're doing this, in 2 weeks in Vegas, I think. But it's a great way to help people look at the concept. And remember, the concept that we're trying to do here is to help that business owner who is living on less than what they're earning. Now, just for the record, when the client is spending every dollar they're making, they need to call Dave Ramsey or Susie Orman. We can't help them. Okay? But for that business owner who's making a lot of money and living on less, but is income stacking and pushing themselves in the higher tax brackets like New York, New Jersey, Illinois, California, and some other wonderful states. Once you get past that $1 million threshold of profits hitting your 1040, this becomes very, very expensive. Next slide for me, Doug. So this is Doug Dickey. He's a certified exit planner. We got here because we wanted to be able to help people understand better ways to do things. And this is part one of a two-part series, because Doug and I have learned as we start introducing this concept to people where they go, wow, we've never thought of it like that. They start thinking of additional questions like step up in basis issues, 1031 property out of C Corps and things of that nature. The process next week on February 6th is going to answer a lot of those other questions. And what we're going to ask is that if you have a question, just send it to me in an email. And we're going to compile all the email questions from today and from next week into basically a document so that we can say, hey, these were the questions that you guys asked. Some of you are going to have the same question. These are the responses, and we'll just do a global response to all the questions after we finish the program next Tuesday as well. Next slide, Doug. So how did we get here? TCJA was one big piece of the puzzle that got us here. And another thing that we're going to touch on at the very end of this presentation is this concept can also be used if you have a client who is in an 831B captive insurance structure and they're looking for a way to exit in a tax compliant manner. So we have been getting a lot of calls on how do we rescue some 831s. Next question. Next slide, please, Doug. What you're going to learn is that this concept is an issue of timing, combining, and sequencing. The concept in and of itself, just a C Corp, is not going to create the solution. Just a management service organization with 2 S Corps is not going to create this same solution. So there is a component of we have to do this first in this manner, sequence this way every year. This is not one of those things where you just set it and forget it and hope that everything runs. This is something that will have some maintenance and administrative and reporting requirements that the local CPA will have to be helping do to help this process truly work for the client. So ladies and gentlemen, I'd like to introduce Doug Dickey. He's the guy with less hair than me. He's a little tall. When I first met Doug, I was surprised at how tall he was. He's a Houston boy, played baseball down there for some university. I forgot the name of it, but it wasn't Alabama. And, we've had a good time over the years. So Doug, please take it away.
Sure. Thank you, Ed, and thanks everyone for joining us this afternoon. I hope this is information that will maybe give you a chance to look at things a little bit differently. I think most folks on this webinar are advisors, so they're working with clients on different circumstances, and maybe this is just a different way of looking at how to structure their operations to achieve a different result. And Ed was saying is really basically three components that we try to achieve out of this structure. We'll walk through each of those three. The first being it's a way to improve asset protection, and we'll talk about how that concept comes into play. It increases tax efficiency by lowering the top marginal rate, which in turn lowers the effective rate for clients. Third is looking at how you're paying for certain goods or services and determining where's the best place to pay for them so you get the most bang for your buck, so increasing purchasing power. Those are the three things we're trying to accomplish. But before we get started with the concept of the structure of the MSO, I want to talk about the concept in which this structure needs to live. When it comes to professional services, it's long been our feeling that people buy professional services in a piecemeal fashion, which is wrong. Meaning the client comes and talks to the CPA and we tell them, okay, we can help them with items 1, 2, and 3, but go talk to their attorney about 4 and 5, their financial planner about 6 and 7, and maybe their insurance or risk management person about some others, or their banker. And so we end up as counselors bouncing our clients around like ping pong balls, trying to get the same story repeated to each professional, and then have each professional opine on what they think needs to be done in those instances. Well, there's a lot of problems with that approach. First, bouncing the client around when the client's actually coming to us for service seems like a bad concept to begin with. Second, who among us can repeat the same story exactly the same 3 or 4 different times? It's impossible. It's like the game you played as a kid in elementary school. And then the third component is each of us have different backgrounds, education, and training. And so we all look at things and assess it based upon our background, education, and training. So we all may be very capable people, but we're looking at things differently. And when you combine that in a collaborative approach, that's a very powerful approach. When you separate them and you're doing that advising independently, we feel like that can create confusion and sometimes perceived conflict when it's really just a difference of perception, right, for each of the professions. So we're big believers on a collaborative approach where you have financial advisors, law firms, CPA firm, in any other type of advisor that's a core component of the support of that business, getting on the same call in the same room, electronically or physically, and hearing the story and coming up with what's the proper assessment for that client, what are the issues you understand, and then collaboratively, in agreement, coming up with what's the solution for the client to move forward, and then help the client move forward and implement that. Right? That takes the client out of the middle of that ping pong match of being bounced around. And so when you see this structure, it requires legal services, it requires accounting services and tax services, it requires financial planning services, it risk management services. And so there are components of those, because if you think about it, all of our clients do require those, right? It's just that they're receiving them piecemeal. So this slide is our attempt to say, let's stop that and come together in an aggregated manner. You certainly need to be able to support this concept. This is a graphic of how we see most of our clients that come to us. You know, our firm works with small and middle market businesses, and most small and middle market businesses are formed as some kind of flow-through entity, either an S corporation, a partnership, or a disregarded entity. And it's done that way for a number of reasons, especially in the beginning, when you're basically consuming everything that you're earning, right? You're starting off, you have losses you want to flow out to the owners. You're not in a higher tax bracket because you just don't have the earnings there. And so it's not as big a tax issue. It provides asset protection, and it just makes it easier. You file a business tax return, the K1 gets picked up on the individual's return or on Schedule C. and then you simply file it and go on from there. But as Ed was alluding to in the beginning of this discussion, when people start having income in excess of consumption, consumption here is personal consumption, housing, food, clothing, vacations, that sort of thing. When people start having earnings in excess of consumption, that's when that single tier can become inefficient. Meaning, if my wages put me in a 30% or 32% tax bracket, when I get a K1, I don't get to start over at the 0%, right? And come up, that K1 gets added on top of my W-2 earnings, driving me into higher and higher marginal tax bracket on those additional earnings. So in federal perspective, it's 37 to 40%. And some of the states that Ed was alluding to or mentioned earlier, federal and state taxes are more than 50% as a combined basis. And so, does it make sense to earn $1 when you're giving half of it away, right? Or could you structure yourself in such a way that you get to keep more than just 50 cents out of each dollar? And that's the concept here. Because you see, if they're paying taxes in a 40% tax bracket, even that 60 cents, they go invest in other stuff. And that other stuff ends up being on their personal tax return generally as well, because it's all flow through. So that creates the income stacking Ed's talking about. You got W-2s, K-1s, 1099s, you got other income streams, all being taxed at the higher tax rate. So what worked great in the beginning, oftentimes doesn't work great in the end, right, later on. And so I think a lot of our clients get into a rut of it was set and forget kind of a thing, right? That you just set your structure, but you haven't necessarily taken a look and said, okay, is this the best structure for me today under current rules and regulations to be able to operate everything in this flow through manner? So that's where we're coming from when we look at those circumstances on clients coming on board. So we took a concept it's not a new concept. We certainly didn't invent it by a long shot. It's been around probably since the beginning of law school and litigation on liability protection, and just simply took it and added some tax concepts to it to be able to create some tax efficiencies and purchasing power increases. So let's put tax aside for a minute and talk about why people use management services organizations and have for eons. And it's really asset protection, right? When clients, entrepreneurs, set up certainly multiple businesses, like they have one who's a manufacturing company, one's a distribution company, maybe a real estate company, maybe a franchise or some other kind of business. They set up these separate legal entities with the belief that it's necessary for an asset protection. It is. And should one company get sued, it hopefully protects the assets from the other, right? That's why we set up these multiple entities for our clients. Well, the element there is, are they operating them in the way in which they need to be able to keep them protected and separated? Not the fact that you can set them up, but can you operate them that way, right? Because there's basically 3 ways to pierce a corporate veil. And there's an error of creation, or some kind of flaw. Somebody did it themselves, went online and filed their articles of incorporation or certificate of formations, but they never adopted bylaws or operating agreements. So there's an incomplete formation. So if you didn't abide by the statutes, then you're not entitled to the protection of the statutes, right? So if they have competent counsel or somehow get it done very quickly, so that it looks like there was competent counsel in place, then there's believed to be protection in that structure. The second one is an error of transfer. They may have set up the structure to hold an asset, a titled asset, whether it's real estate or rolling stock, and they never transfer the title of the asset there, right? So it's like they made this vault, but they never put the asset in the vault. They go check the title and it's still titled in their name individually. Well, I don't have to pierce the veil. I just have to get a judgment against them and I can take the asset because it's now their asset. But the MSO was designed to combat the third error or way of being able to pierce a corporate veil, and that's an error of operations. It's in essence a commingling. You have one company paying or using goods or services from another related party without adequate consideration, meaning you got an employee over in company number 2. The employee in company number 1 doesn't show up for work today. So you take an employee for company number 2 and they go to work over at number 1's location, yet they still remain on the payroll of location number 2. Well, that's a commingling. You're treating those 2 companies as one and the same, right? Exxon would not provide free labor to Shell. And so you have to have separation of activities to have separation of liabilities. Another example is you got a truck in company number 1. Well, the truck in company number 3 breaks down. You think you're not going to make a delivery as an entrepreneur? They're going to take the truck from company number 1, go pick up the goods and go deliver them so they can invoice it and satisfy the customer. Well, did they pay for adequate rent for the use of that vehicle? Was it an agreement outlining the nature and scope of the relationship? If you're not treating them as separate entities, then a plaintiff is not going to be held to a higher standard of proof than the people who actually own and operate the company. That's where that error of operations came into play. And the courts over the years seem to have 4 criteria they look for in determining whether or not they respect that separate sanctity of liabilities between related parties. And here's those 4 criteria. The first is it a separate legal entity? Well, no problem. You can set up as many separate legal entities as you want. So we use a separate legal entity for a management services organization. We choose to have it taxed as a C corporation, but that's the tax side. From an asset protection standpoint, it just needs to be a separate legal entity. The second criteria is there needs to be an agreement outlining the nature and scope of the relationship. In a third-party relationship, there's some document that says party number 1 is supposed to do something for party 2, and party 2 is supposed to pay, right? Whether it's an engagement letter, a services contract, a promissory note, a lease agreement, there's some document that codifies the nature and scope of the relationship between the parties. The third criteria is fair value transfer. You can't charge your sister company $1,000 for something that you charge $100 to an outside party and call it arm's length, because economically it's not, right? Nor vice versa. So it needs to be at fair value. How do you determine fair value? What's the appropriate standard for making sure you comply with that? And then the fourth criteria was actual performance. Did that management company actually deliver the goods or services that were stated in that agreement outlining the nature and scope? And did the operating company actually pay fair value for those services? So it's a facts and circumstances kind of test. And so that's where MSOs were born, is you had, sometimes you heard them called common resource centers or motor pools or equipment resource centers for commonly used equipment and things. And so this concept, like I said, is not new. It's been around for a long time. And they took commonly utilized resources and they put them in a central place so that they could be used by multiple parties under those 4 criteria I just mentioned. So in my mind, I look at this concept and think of it like a wagon wheel, right? You have this MSO that's the hub of the wagon wheel. It's in the middle. And then this wagon wheel has a spoke that goes out to the rim. And at the end of each of those spokes is an operating company. So you can have as many spokes as you want off the wheel and as many operating companies as you want off the wheel. And if that's the case, then you can put your commonly utilized resources, which could be people, equipment, real estate, intellectual property, licensing rights, those things that you would use for the care and feeding of multiple businesses, right? To the extent that something's being used to service the outside world or the customers, it still stays in the operating companies. There's no change there. If you're coming to do business with the outside world, from this outside world, you're doing business with the operating entities. But now if we have these common resources over here in the MSO, then now we can deploy them wherever we want to go to. We have a client that just bought 17 Arby's franchises. And so in that situation, you're certainly going to have situations where people may not show up for work at one of those units, right? So we've separated the units into series LLCs for being able to divide the liability, but we took the employees and put them all under one central PEO relationship, if you will. So now we can lease the employees to whichever location we want to. We simply keep track of how much time and activities they have at each location. The employee gets the same paycheck from the same paymaster every pay period, but now we have the ability and flexibility to be able to utilize employees anywhere we need them. And so that's the historical concept from an asset protection perspective. So our clients have been known to commingle things from time to time, right? And so we had used this structure for a while to try to protect our clients from themselves. And understandably so, they're small and middle market business people just trying to make it work. So if we're doing this from an asset protection perspective, what else can we do with it, right? What else can we do to achieve a different result? Can we change operations or change structures in such a way that we get something different than what we've got? And is that difference better? And so that took us down this path of, okay, how do we bring this together? You know, as accountants and tax people, we have these different sets of rules, right? You got C Corps, S Corps, partnerships, you got disregarded entities, you got estates, you got trusts. Each of them have different sets of rules, and there's pros and cons to each of those generally. And so, you know, how do we marry those? And so we started looking at this concept long before TCGA came out, and had been using it in our firm for over 30 years. TCGA changed the parameters of it, but it didn't change the concept. And here is the concept. Since TCGA, C corporations have a flat 21% tax rate. Okay, it doesn't matter whether it's $1 or $1 billion. It's a flat 21% tax rate. Flow-throughs, once again, don't pay tax generally, except for, you know, one state has a S Corp level tax, but the individual does. And our tax structure in the United States is aimed squarely at we humans, right? The majority of our tax revenues comes from human tax, not business tax. And so you get into the 37% tax bracket, and then everything thereafter is taxed at that 37% to the feds. If you then take some of those dollars and you go invest them in investments, you have the pleasure of paying that net investment income tax of another 3.8% on top of that. And if you live in a state that's got a state income tax, then the governor gets their piece of the pie as well, right? So technically the top tax bracket in the US from an income tax perspective is 37%. A lot of people talk about it as being 40% because of Obamacare or Medicare in addition to that. And then like I said earlier, with the states, it can go to as high as 50%. Prior to TCGA, C corporations had tax brackets, for those of us that can remember what tax world looked like prior to 2018. In those days, C corporations, the first 50,000 was taxed at 15%. The next 25,000 was taxed at 25%. Then above 75,000 was taxed at 35 to 39%, depending upon what the level of income was and the types of income. And so in those days, we would use the structure for asset protection, but we would try to manage the income of the MSO such that we would have enough income going into the MSO to cover all the operating costs, as well as to be able to leave about $75,000 of profits after tax. Because you see that blended tax rate of 15% on 50 and 25% on 25 was a 17.67% tax rate. And during that time period, our individual tax rates were as high as 60 and 70% at the federal level, right? So it's an arbitrage, it's a difference between them. So in today's world, if you're in a 40% individual tax bracket or even 37%, you got $100 coming through an S corporation and down to the individual, you're paying tax of 37%. If we could take that $100 and have it taxed at the C Corp by virtue of paying a management fee over to the C corporation, we only pay $21 in tax. Okay, 37, 21. That $16 spread, 16 is not a big number, but when you look at what you would have left over after paying a 37% tax, 63%, and it's like accumulating another quarter of a year's profit, right? Or every 4 years is like having a whole nother year's profit without selling another widget, seeing another patient. It's simply a way to accumulate more capital for growing and expanding a business or growing wealth, like what Ed was referring to. So that's the tax efficiency concept on being able to accumulate wealth. The first phase of it is just simply this arbitrage. We'll get into some of the other phases of how it compounds after that, but that's the initial concept. The third component is there's some things we can do in the C corporate world that we can't do individually. Like C corporations have 4 or 5 different ways that you can have unreimbursed medical expenses paid for and deducted at the C Corp level that a 2% or greater shareholder would not be able to do. Those 2% or greater shareholders would only be able to deduct those medical expenses to the extent that they exceed 7.5% of their adjusted gross income. So most of our clients would never have an opportunity to be able to deduct those. Long-term care is another thing that can be paid for and deducted into a C corporation for a greater than 2% shareholder. So it's a way to be able to transfer some expenditures from being after-tax dollars to pre-tax dollars. But there's also some other things that we pay for with those after-tax dollars, and it's just simply cheaper to pay them in a lower tax bracket. Here's conceptually what I'm talking about. If you're in a 0% tax bracket, you only have to earn $1 to pay no tax and have $1 remaining after tax. If you're in a 50% tax bracket, you have to earn $2 to pay a 50% tax and have the same dollar remaining after tax. So it takes more earnings to have an after-tax dollar in a higher tax bracket, right? That's conceptually makes sense. Well, here's the math under the Fed rates at this point, assuming somebody's subject to the Obamacare. We're at that 40% mark. In a 40% mark, you have to earn a bit north of $1.69 to pay a 40% tax and have $1 remaining after tax. In a 21% C corporate environment, you only have to earn $1.27 to pay a 21% tax and have the same dollar remaining after tax. So to pay for something under these tax bracket differences requires 42 cents per dollar less earnings in the C corporate environment. If you take this to California and you're over 50%, now you're talking about $2 rather than $1.69. So you can see the differences on purchasing power. Well, what are some of those things that we pay for with after-tax dollars? Well, disability premiums is generally one, especially in professional practices, right? That disability, the rules are if you deduct it, then the benefit, should you become disabled, is taxable. If you don't deduct it, then it's tax-free. So most folks don't deduct those disability premiums. So should they become disabled and their income is significantly reduced, then the income is tax-free rather than taxable. Life insurance is another component. People are using life insurance as retention bonuses, as deferred compensation plans. They're using them as basically another component or asset class from a financial planning standpoint, where you're able to get tax-free growth like you would in a muni bond, but you get a much greater yield inside some of these products that are out there. And so depending upon where you are, there can be much greater utility of the dollars you have to pay for those benefits. And the third one that's a big one for most businesses, especially businesses holding a lot of real estate or equipment or just acquired a business, that sort of thing, is principal on debt, right? The interest is deductible on business debt generally, but the principal is always paid with after-tax dollars. What if we could reduce the earnings required to pay for that principal by 42 cents per dollar? And that's what we're talking about here in this slide. If someone borrows $1.2 million and they're in a 40% tax bracket, they have to earn a bit north of $2 million in order to be able to pay for the tax and still have the difference. Whoops, sorry. Still have the 1.2 million remaining in order to be able to pay to the bank and pay off the loan. Well, if you're in a C corporation with a 21% tax bracket, you only have to earn a bit north of $1.5 million. So it's a little over $500,000 savings on a $1.2 million loan. That's the 42% we're talking about. So we've restructured a lot of clients' holdings in debt under C corporations in order to be able to pay that debt off faster. This 42% is just the tax arbitrage difference on the principal. But what if you pay the loan off 42% faster? Do you think you save some interest? Right? There's a reduction in interest cost as well. And so there's an additional savings depending upon how you use that cash. You use it to go ahead and pay the debt off, and that debt gets paid off your back faster. You have less interest to pay. It reduces the overall cost as well.
And Doug, I want to point out that even though you're using only federal numbers here for comparison ratio, if you live in one of the lucky states where there's a very generous state income tax, this works even better.
Exactly. I mean, in California, it's over $2 to get your dollar after tax. So this concept, we have several bankers we've gone through and restructured loans with. We've actually gotten calls back from some of them to help structure transactions so they could make the loans. And in lending, they generally look for a 1.25 to 1.3 times debt service coverage. That's sort of the normal range of what it takes to be able to qualify for the loan. Well, that debt service coverage is an after-tax debt service coverage because principal is not deductible. Well, if we could increase their debt service coverage by 42%, then they now qualify for financing they wouldn't otherwise be able to qualify for simply because of that after-tax cash flow difference. And so this concept has been used in a number of different environments. I want to talk about double taxation with C corporations. It's not a myth, it's real, but I want to talk about the differences and why it may not matter to folks as much as it used to. So to compare apples to apples from just a pure income tax perspective, we took Obamacare tax and Medicare tax and anything else off the table and went straight federal income tax rate to income tax rate. So if you have a flow-through entity and you're in a 37% bracket and you have $100 worth of income, you pay $37 in tax. That's the math. Well, if you have $100 that runs through a C corporation taxed at 21%, then you have $21 in tax. That's the same math, right? That's that $16 difference I was speaking about earlier between 37 minus 21. So that leaves $79 after tax, right? That's the additional capital accumulation by virtue of restructuring the income streams. Well, let's assume you violate what Ed was talking about. If somebody doesn't want to accumulate capital to grow their business, they don't want to invest in anything, they don't want additional benefits, they want to consume everything that they earn for their own personal living. That's generally not the case, and it's certainly not the case for people that this would be applicable to, but let's assume that it is. And they take that $79, they pay it out as a dividend taxed at 20%, the federal top dividend tax rate. Well, that dividend tax would be about $16, right? 20% of $79 is about $16 tax. Well, if I paid $21 in corporate level tax and $16 in dividend level tax, I would have paid $37 in tax to bring $100 through a C corporation and out to me, which is exactly what I would have paid in the year it was earned in any of the flow throughs. That's actually how Congress came up with the 21% tax rate when the House and Senate were negotiating TCJA. This computation is how they arrived at the 21% tax rate. And so the difference in tax is a timing difference. Do you want to accumulate $63 or $79 out of each 100 to go forward? You pick and choose if and when you'll ever pay this 20%. Because people talk all the time about, okay, what if they sell all their assets and they have to distribute it? Well, they don't have to distribute it. This MSO, as people go forward, they use the MSO as sort of the family office, right? They may sell an operating company, they may sell other holdings, but they're not just going to consume all those dollars. They're going to reinvest them into other things. And so that management company continues to be their family office to manage their assets and their holdings. And so it continues to provide benefits even on after the times that they sell their operating companies. And then the stock held from that MSO is simply an asset of their estate, and it transfers to the next generation. Or, C corporations can be owned by anybody or anything. So we can establish family limited partnerships or trusts that own that C corporation. And then the capital accumulation is already to the next generation without transferring it through an estate tax environment. And so when we think about double taxation today, it's a little bit differently. And I do realize we haven't, the qualified business income deduction for a 20%. But remember, that just knocks the tax off of the top 20%. You could still be in a 37% tax bracket. So the goal we're having is we're lowering the top marginal rate, which lowers the effective rate. And we just simply look at where we need to be for being able to manage that tax both individually and in the corporate structure. I want to walk through kind of what this looks like from a math standpoint, and you'll be able to see what I mean by the compounding effect of this accumulation of capital. Okay. This is an individual. It has $300,000 in excess of what they need to consume. Okay. We're assuming that they're in a 37% tax bracket. Corporations are taxed at 21%. Dividends are taxed at 20%. And then to the extent that they have earnings that they're getting off of their savings, they're making 6% off of it, and those earnings are taxed at a blended 28% rate, meaning part capital gains and part ordinary income or short-term capital gains. We're also assuming there's some life and disability premiums they're paying, and this is the savings off of the reduced cost for being able to pay those in lower tax bracket. We're assuming there's some unreimbursed medical expenses that they previously were paying after tax, we can now deduct and pay pre-tax. And we're assuming that there's some debt level out there too, that they're currently paying with those after-tax debt dollars. These savings are not available individually, but they are through the lower C corporate environment. So what does that look like for folks? Well, if they earn $300,000 today, they're in a 37% tax bracket, they're going to pay $111,000 in tax, leaving $189,000 after tax. Assuming they do the same thing next year, another $300,000 worth of earnings, 37%, $189,000 remaining, but they took the $189,000 and they invested it and they earned 6% off of it. That's where the 11th grand comes from. But they paid tax at the 28th percentile on those earnings. So at the end of year 2, you can see the accumulation here, year 3, year 5, year 10. This is where they're heading now. Okay. Now let's assume we take that $300,000 and we're able to bring it to a management services organization taxed as a C corporation through management fees or simply by moving the ownership of the assets that generate the income into the C Corp. In a 21% tax bracket on $300,000, you have a $63,000 tax liability, leaving $237,000 after tax. But remember, in the C corporation, they have these additional savings from the payment of their disability and life premiums and unreimbursed medical expenses and the principal on debt of another $29,000. So they actually end up with $266,000 left after tax, as opposed to the $189,000 you saw in the previous slide. Assume the same thing happens the next year. That $266,000 now growing at 6% produces almost $16,000 in earnings versus the $11,000 in earnings you saw in the previous slide. Those earnings are also taxed at the flat 21%. Remember, C corporations don't differentiate between ordinary income, long-term or short-term capital gains. It's taxed at the flat 21%. So now they end up with $544,000 at the end of year 2. And that's what this table is showing here is there they are individually. Here's the results in a C corporate environment. And here's the difference of accumulation of capital for growth and investment. So this is how they're earning and keeping more dollars simply by restructuring how they're holding their assets and their activities. And you can see the difference at 5 years, 10 years, and so forth. So that's the compounding difference. You're not only saving dollars off of taxes, the tax arbitrage, you're making more money because you have more money working for you. And you're also saving dollars by virtue of the fact that you have increased purchasing power for after-tax expenditures. So I said, okay, this is fine. We have a difference. What if they want to take everything else out of the C corporation and consume it all in the same year, right? I mean, which of your clients have ever sold everything they've got and spent it all before midnight, December 31st, right? And been penniless by the January 1st of next year. It doesn't really happen that way, but that's the mindset of folks is, okay, when I distribute it out, I'm going to have to pay tax on it. Would you rather pay tax now, 10 years from now, 15 years from now, or 30 years from now, right? And what's the accumulation difference and earning power difference between now and 30 years? So I said, okay, let's assume that we pay a 20% tax on whatever is in here, right? We're paying dividend tax. So if we do that, this is 80% of this number here. And this is the difference between what they would have had individually and what they have with the MSO structure. The savings predominantly is from some of the cost savings and then the growth accumulation. Because remember, ultimately, you're about back into that same 37% if you pay it at both corporate tax rates and dividend tax rates. But money has a time value, and you can see the increase in yield based upon that difference. And so that's the concept. It's not just a tax bracket arbitrage. It's a purchasing power increase, and it's an earnings increase based upon having more capital working for you longer. And this is assuming you do no tax planning on the exit of those funds out of the C corporation, and that you exit all the money and you die penniless by exiting everything out of the C corporation. Jason Kirchner is going to talk more about some of these exit strategies in the next presentation that Ed had referred to. We'll show how you can bring those dollars out without having to pay the second tier of tax. We've talked briefly about perhaps some estate planning where it just doesn't matter because it's already into the next generation anyway. I want to talk about a couple of other things too that with this structure. Remember that C corporation can be owned by anybody or anything. That's the estate tax concept we talked about. But sometimes you have situations where you have husbands and wives have different businesses. And prior to Secure Act 2.0, they were tied at the hip from not only an income tax standpoint, but from an ERISA perspective, right? And I've got several clients where, like, you have the wife may be a dentist and the husband's an anesthesiologist or a cardiologist or something. And so if there's a qualified plan in one of those historically prior to Secure 2.0, then basically the other party was kind of barred for being able to utilize the same benefits that they would be able to have for flexibility if there wasn't married to somebody who owned and controlled a company with those same benefits. And so with Secure Act 2.0, we no longer have control group issues between husbands and wives. And so we can have operating companies and MSOs. So we can set up separate structures for being able to provide benefits and to separate liability between husbands and wives. A lot of times there's issues like that, not just from a prenuptial perspective, but from an operating risk perspective. When you have an affiliated service group, then that's a different issue. If the husband's MSO is receiving compensation for managed services from the wife, then they are still tied at the hip because the affiliated service group rules, but not the control group rules. So 401ks, profit sharing plans, defined benefit, cash balance plans, those are all in place. But then we have all of these other health insurance or reimbursement concepts that allow us to be able to do different things. Most deferred compensation, the problem with deferred compensation in small businesses is you don't get to deduct it until some other party picks it up as income. So being able to pay for premiums or put dollars aside with 42-cent cheaper dollars makes it more affordable for being able to tie key people to existing operations. So golden handcuffs come into play under that type of structure. Education assistance, dependent care program, adoption programs. There's a whole group of other benefits that are available for a greater than 2% shareholder of a C corporation that simply are not available for a greater than 2% S corporate shareholder. So that's sort of the baseline overview of utilizing different structures to achieve a better asset protection perspective. Once we're in that position, utilizing different types of tax structures to get a reduction in tax or tax efficiency increases. And then also looking at how we're spending dollars to determine where's the best place to spend them to get the most bang for your buck. Ed mentioned at the beginning of this about 831Bs. There's been a number of folks had gone into 831Bs for decades before because Congress allowed it, and the law allowed for you to be able to put aside dollars to manage risks, and your own captive insurance company to be able to have rainy day monies if something happened, or have coverages basically that were not available in the commercial marketplace. And that provision, for those who aren't aware, allowed you to be able to put aside in the beginning 1.5 million, then it became like 2.2 million, and now it's like 2.65 million or more, and premiums without having to pay tax on those premiums. That's the 831B provisions. Well, since 2016, the IRS has been under siege for those for 831B captives. A lot of people have gotten off the playing field with those because they simply don't want to go through the hassle of dealing with the IRS's reporting requirements under the Notice 2016-66 they issued originally, and then the proposed regulations they have now, where it could be a transaction of interest or a listed transaction. We believe that those are probably going to go away, the IRS's position within the next year or so, because there's over 1,000 cases pending with tax court right now where the taxpayers disagree with the IRS's position on that. And the good fact cases are coming to pass, and the IRS is dropping those cases because they don't want to create the precedents for being able to have those go to be to law. 831B is a provision of the tax code. It absolutely allows for that to take place, for you to have a captive. The concept of what constitutes insurance was established back in 1939 by a Supreme Court case. So it's not a matter of law whether it's allowed. It's a facts and circumstances about, do you have appropriate risk shifting and risk distribution and underwriting and that sort of thing. And so the tax court's not going to want to try 1,000 cases on the same topic. They're going to come up with some rulings, and I think it'll make that go away. But if you have clients that want to get out of the captive business now and wait for this to resolve itself in the courts, then there's a tax efficient way to do that. Right now, when you have a captive, all captives are C corporations basically. And so if you dissolve them, then you'll pay the dividend tax and take basically a 20% haircut, or possibly 23.8%, depending on tax bracket at that point in time. Well, two C corporations, as long as there's not a material change in the ownership interest, can merge tax-free under 368. And so what a number of folks have done, we've used the MSO structure for their operating companies to be able to operate their business as it is. It's already needed as a part of their operating component. Well, once you renounce your license as a captive insurance company, you're no longer eligible under 831B, not an insurance company anymore, and you're simply a corporation. Well, if the ownership of the MSO and the corporation are the same, then you can merge those two companies tax-free, provided you have an ongoing business. Well, a management company is an ongoing business, and you use a significant portion of the assets as capital. Well, they're going to deploy that capital one place or another anyway. So real estate, other business equipment, that sort of thing can be used there as well. And if you do that, you could save 20 to 23% of your capital accumulation by virtue of exiting that structure, doing away with having to file the 88, 86 forms every year, and preserve what you have accumulated in your capital on a tax-free basis. And so this is an exit strategy that Ed and I had spoken on back last year to a group that was interested in the captive environment. So as sort of a summary or conclusion on things, who's an ideal candidate for this, right? What makes sense? We think it's folks that have taxable income of $1 million or more. If they're in $1 million or more taxable income, they're definitely in the highest tax bracket federally. And even in California, they're in a 12.3% versus 13.3 at like 1.3 million or so. So they're well into the 40 to 50% tax brackets. If they have annual life insurance premiums or unreimbursed medical expenses or disability premiums or debt, those are those additional cost savings components we talked about on increased purchasing power. We also have some other folks who are trying to groom their business for exit, and they need to be able to retain key employees. Well, would you like to reduce that cost for the retention of those folks by 42%? This is an opportunity to be able to do that going forward. Or if you simply have multiple operating companies, you want to stop violating your asset protection. We have clients that have utilized this structure for its historical purpose of just pure asset protection as well. So clients with any of these attributes, or certainly any combination of a couple of these, would be a candidate for being able to use this kind of planning structure. What we've done historically is, if, this is sort of a discussion of the higher level of conceptually how it works. If clients want to understand how it works, we would go through and ask for a couple of years worth of tax returns, business and personal, get them to answer these 6 questions. And then from that, be able to put together a tax memo outlining the way in which this would affect them, what would be the actual savings for them. And that way, ahead of time whether this makes sense or not. I think there needs to be an assessment or analysis to do that. We've done that historically at no cost, just to make sure that we understand that is this appropriate for these people or not. So that's the concept of the MSO, and a very high level and fast-paced environment to talk about increased asset protection, increased tax efficiency, and increased purchasing power. And then some of the other planning concepts you can start doing with this once you have the structure in place.
Well, Doug, thank you. This is why I wanted a lot of you guys to see this, because I'm always asked, how does this thing work? And as you saw through Doug's walkthrough of the timing, combining, and sequencing, this is way more than just somebody setting up a C corporation, way more than an attorney drafting just an MSA. This is way more than just 1 or 2 things trying to accomplish. This is a comprehensive model. And Doug, if you would, go ahead and you can stop the share. Folks, what I'd like to share with you is that when we look at clients who have the scenario that are eligible for this, particularly those of you on the accountancy side, how many times do the clients come in going, by the way, we just bought a bunch of key man life insurance policies. By the way, we just went and borrowed $5 million to buy a new building. By the way, I mean, how many times does a client come in letting us know about what they've done? And then we're sitting here going, oh my gosh, you're going to be short on cash. Cash management is going to be tough. We believe there's a huge value add as a collaborative group of advisors. When the clients do these things, one, if we can be on the front side of say, hey, here's the better way to do the loan structure. Here's the better way to buy a key man. Here's the better way to look at succession planning. And if they hit the right points that we're looking for, we strongly believe that this is a powerful strategy that works for a select group of people who are entrepreneurially focused, who have multiple businesses. And I didn't want to interrupt Doug earlier, but I can tell you just from my small client base, 90+% of the time that I meet with a client with 2 or more business entities, they are committing the error of operation. They're commingling assets. It is evident almost every single time. And the client's like, well, the attorney told us all we need is to have a corporation or an LLC and we have guaranteed asset protection. But yet you see the money's being spread back and forth, employees and trucks, and they don't. They misbelieve. It's just crazy. So what I hope you've been able to see today with the spreadsheets, that we can put facts on paper to prove when this will work for the right client. And so if you're interested in this concept, I beg of you, come back for part 2, which is next Tuesday, February 6th, 11 o'clock California time. And then we're going to start addressing the other piece of this equation. We've set up the concept. The client has done it for 5 or 10 years. We're looking at a business exit. We're looking at maybe a succession plan. We're looking at how this fits in the estate planning computations. How does this work even better for those things as well? So be sure and mark your calendar, February 6th, Tuesday, 11 a.m. California time. And if you need the link, just say, Ed, I've lost the link, and let me know. I do ask that you send all your questions to my email address at ed@olympustax.com. We're going to compile all your questions from this group and the group on the February 6th model. We'll put it all together. We'll send it back to you. If you want to hear this again, reach out and let me know. Doug and I do this presentation, it seems like every month now. We're doing it either online or in person somewhere. But feel free to send us your questions. Any questions before we close, or any comments, please just send them to me in an email, because we're at the top of the hour and I want to make certain you get a chance to run to the bathroom. Folks, great for being here.